Good afternoon.
Good afternoon, sir. How are you?
I'm good.
Thanks for joining.
Oh,
Such an exciting topic, huh?
hey, this is where the rubber meets the road. It's not how much you sell it for, it's how much cash you put in the bank.
Yeah, that's true. I know. Everybody's concerned about the top line, the highlight price, right? The sales
Yeah,
price. But you're right. You can give away a lot of it. A lot of it can be gone by the time it gets to your bank account.
yeah, it's almost impossible to get people to concentrate on this 3 to 5 years before a deal,
I know. I
but
know.
it that's what I'm here for is talking point.
Okay, cool.
How do I
Well,
get how do I
well,
get people to think about
hopefully I'll
this?
give you something of value, Mark. I will
Oh,
try.
I
Trust
thought
me.
the last 2 were quite well done. I wouldn't be here if I didn't enjoy them.
All right. Well, you're my fan of one. Then I don't see somebody else jumping in, but I know the stuff is recorded, so perhaps that's why
Yeah,
people just listen to it at their leisure, as opposed to blocking out an hour during their day, when they maybe just. So I'll give it another minute, and we'll see who shows up, and if not, I'll just get right into it. And this one's going to be a little bit different. I mean, not a little. They're all different.
right.
But this one here is going to be more about, once you have agreed upon the total purchase price, let's talk about
Yeah,
tax, some of the transaction tax traps that you could come across as start closing, before as you're negotiating the final contract. There's a lot of tax issues that need to be ironed out. So that's kind of what we're going to talk about today.
yeah, no,
Uh,
I love it. I love it. I'm really
So what is your background, Mark? Are you a CPA? Do you do accounting work? What is your background?
Wait, I I started my career at KPMG in tax,
Oh, okay, cool. Then
like
you know.
almost 10 years, but that was, back in the
Last
early
century?
80s. Yeah, yeah, back, Moses and I did tax together. So,
On those tablets.
yeah, it was that bad. Speak.
Uh,
I remember when I was recruiting, they had one room and they had an Apple or a Mac something, and that was like the holy grail. That was their first computer. They bragged about it when I was recruiting. That's how long
yeah.
ago it was. But and then I went off and I did a lot of really aggressive tax planning for my next gig. We built power plants.
Okay.
I ran as controller there as well as tax.
Okay.
Pretty aggressive stuff, and then moved away from that basically into finance since it lasts forever. So, so I'm not
All right.
current tax at all.
Yeah, that's okay. All right. So I guess I'll start. Let me share my screen.
I'll be here.
All right. I guess you could see it, right, Mark?
I can. You,
All right.
you might want to. Are you on? Oh, I'm sorry. Are you on presentation or
Yeah, I'm on presentation mode.
right? Because it's a screen within a screen.
Yeah,
So
I see it.
okay, maybe a full
Oh, okay.
look
I thought I did a full there, but I'll try it again.
there. That's a little less distracting now. Good job.
Okay. Can I make it bigger? I guess I can. I'm not very good at making these things bigger, but let me see.
Well, it's on a
There you go.
pretty big screen, but yeah.
All right, there you go. So you can now see it, right?
Well, now you've put something else in the way.
No,
Yeah,
I'm putting this up, so you can now see that, right?
I
Okay.
can see. It's
Oh,
fine.
what did I do? I moved it again. Now you can see it, right?
Yep, I'm good.
All right. Let me.
Voice allocation.
Yeah. Let me move this to the beginning here. Okay, hold on one second. I thought I could look at this, but I guess I can't. So let me get my talking points here before we go forward.
No problem.
All right. Okay. Let me go back one. Sorry about that. Okay, so thank you, everyone, and Mark. Um, so today, we're gonna, this is a third in series of webinars that I'm putting on about tax implications around selling a business. And today's sessions is going to be really focusing on deal terms that can that have significant tax consequences. So you don't need, as an advisor, you don't need to be the tax expert in the room, but by spotting issues early, asking better questions, and involving counsel before the opportunities are finalized, you can really help protect substantial value for your clients. And so today's topics are not technical tax issues for tax professionals alone. You're going to see how they're going to affect the amount of cash that the seller keeps, also how quickly the buyer gets deductions, whether the gain is taxed as ordinary income rates or capital gains rates, and whether or not disputes could arise after the closing rather than before. So again, the focus today is pretty straightforward. Uh, which tax sensitive deal terms should you, as an advisor, identify early? Again, you don't need to calculate every outcome, but you should recognize the issue, understand why it matters, and know when to bring in the right people into the conversation. So, with that said, let's start on the first big topic here, and that's purchase price allocation. Okay. So let's start with that because this is one of the issues that sounds technical, but it's really an economics issue in disguise. Okay. So at a very high level, purchase price allocation is essentially the agreement between the buyer and seller on how the total purchase price gets assigned amongst the assets being sold or deemed to be sold. You're going to see this a lot when there's a straight asset sale, and you're going to also see it in certain stock deals that are treated as asset sales for tax purposes. We talked about that in the last webinar when we talked about the 338H10 election, which treats a stock sale as an asset sale. So why does this matter? Well, it matters because while the total deal price may be fixed, the after-tax outcome is still very negotiable. And allocation of the purchase price affects the seller's after-tax cash because it determines what amounts are taxed as ordinary income, which can be taxed up to 37%, or capital gain income, where the maximum rate is 20%. And it also affects how quickly the buyer can recover the purchase price through deductions. So this is not just a reporting issue, it's really part of the economic negotiation. So when allocation comes up, the parties are not arguing about forms, they are arguing about value. And on one side, on one side, there's tax deductions, and on the other side, there's a tax cost. So that's why this deserves a lot of attention, often very times early in the process, not after the purchase agreement is basically finalized. So let's take a simple example of this. I know it's a busy slide, but let's talk about what this looks like. So here's an example where the total sales price here is $10 million, and I'll point to it with my pointer here. Total sales price is $10 million. And the seller's basis and the assets sold is $4 million. You can see it over here, $1 million in receivables, $2 million in inventory, and $1 million in net book value for equipment. All right. And therefore, the gain here is going to be about $6 million. But how that gain is taxed is very significant. So here, when the purchase price allocation, as you see here, is we're going to allocate 900,000 to the receivables, 2.5 million to the inventory, 2.5 million to the equipment, and the balance is going to be caught up in this catch-all category or this intangible bucket called Goodwill. Okay, and as you'll see in a moment, let's talk about it. So the accounts receivable, the inventory, amounts allocated to those two amounts are going to result, as you see over here, in a gain or a loss. But that gain or loss is going to be treated as ordinary income to the seller. Ordinary income, not taxed at preferential capital gains rate, but at higher ordinary rates. The amount that's allocated to the equipment is also it's also a gain, a million five, but we'll find out that probably most of that is also going to be ordinary due to something called depreciation recapture. We'll talk about that in a moment. And then finally, the $4.1 million allocated to the intangibles, Goodwill in this case, is going to be taxed at preferential long-term capital gains rate. So the bottom line is sellers usually want more value pushed into this Goodwill bucket, this intangible bucket, because they get capital gain treatment, and less into the ordinary type asset buckets where they'll produce ordinary income. Now, if we flip it around and look at from the buyer side, all right, the buyer's going to want more to be assigned to the assets that they can recover quicker through tax to depreciation or writing them off. But that also causes more ordinary income to the seller. So inventory turns over faster. They'll get to write that off pretty quickly. Equipment may be depreciated quickly now today, especially with bonus depreciation. They could use today under today's rule. They can immediately bonus and depreciate take a depreciation deduction for the entire cost allocated to the equipment. However, the Goodwill has to be amortized over 15 years on a straight line basis. Okay. And of course, that is capital gain to the seller. So the same allocation that's attractive to the seller is going to be, in most cases, less attractive to the buyer. And that's where this allocation often becomes a tug of war. You have the same business, the same price, the same closing date, but very different net incomes or outcomes depending on where the value lands. So the practical takeaway here is this. When you hear parties debating goodwill, receivables, inventory, equipment, that is your signal that the tax issues are affecting the economics. And that's the moment where you ought to slow things down, get the tax team involved, and make sure the parties are not discovering too late that they agreed on price, but not on net value. And again, I'll say it for one more time. This allocation issue should be addressed early and then addressed specifically in the sales and purchases agreement where everyone agrees to how the allocation of purchase price is going to be done. Let's talk about depreciation recapture. Uh, let's talk about this now because this again is a very important concept for the non-tax advisor to understand in an asset sale, right? And the simple idea is this: if the owner has claimed depreciation deductions over the years on equipment and other tangible assets, the IRS then is going to require some or all of the gain on the sale of those assets to be taxed as ordinary income rather than capital gain. That's what recapture means. They're taking it back. They're recapturing it. So why does this matter? Well, because the seller may go into the deal assuming that the sale of the business is going to produce favorable capital gain treatment, but when part of the purchase price gets allocated to depreciated equipment, as I said previously, the tax law is going to say not so fast. Some of that gain is really prior depreciation coming back, and it's going to be taxed as ordinary income. So when you see if there's a lot of value that's going to be assigned to machinery, furniture, fixtures, and other depreciable fixed asset, that can materially increase the seller's tax costs. That is why this concept of recapture should be on your radar. Anytime the deal is equipment heavy, if you have a lot of equipment, deal's equipment heavy, and the owner is taking large depreciation deductions, bonus or what have you, you're going to see how that's going to cause a lot of the gain on the sale of that equipment to come back as ordinary income. So let me just give you an example of what that looks like here. You could see it. All right. So this does a nice job of showing how the recapture provisions work. So in the first row, you have equipment that was originally bought for $100,000. The taxpayer used Section 179, which is an immediate expensing provision, and wrote off the $100,000 immediately. So now the tax basis of that equipment is zero. And let's assume that in an asset sale, it's being assigned a $50,000 value. Okay. So what happens here is that you have a $50,000 gain, but all of that gain is going to be taxed as ordinary income. And the reason for that is because the taxpayer took $100,000 of depreciation in the past and they have to give back any gain and to the extent of prior depreciation as ordinary income, because that's just restoring it, right? You took a deduction to reduce ordinary income. If you sell it at a gain and it's attributable to the depreciation taken, then all that gain is ordinary income. The second example is another one where you have an asset with a cost of 100,000. We took depreciation of 75. We got a basis of 25. We're selling it for 45. You got a $20,000 gain. That gain is also all ordinary income because it's not in excess of the depreciation that's taken. The third example is an example that can happen. I don't see it very often, but it can happen where you bought $100,000 of equipment, you took 25,000 depreciation, you got a $75,000 tax basis, and this must be very important or very valuable equipment because it's sold for $115,000. Okay, so you have a gain of 40, but the gain is going to be split up. All right. The $25,000 of the gain to the extent of prior depreciation is going to be ordinary. And the remaining $15,000 of gain is going to be treated as long-term capital gain. Okay. So, and the last row is another good reminder. Same 100,000, 50,000 depreciation, $50,000 tax basis. You sell it for 30, you got a $20,000 loss. That loss is automatically, that's an ordinary loss. So again, this is how recapture works. And then I guess the takeaway here is don't assume that all gain in an asset sale gets favorable capital gain treatment. If they're depreciable fixed assets in the deal, some of the gain is going to come back as ordinary income. And so that again means that purchase price allocation to these tangible assets can have a direct effect on the seller's after-tax proceeds. Okay, any questions so far, Mark?
Looking good. Thank you.
All right, let's keep moving on. All right, let's talk about another concept that comes up when you're dealing with the final closing on the deal, and that's this installment sale concept. Okay, so this installment sale concept is one of the most important common planning tools in a private business sale. And at the simplest level, an installment sale exists when at least one payment is received after the tax year of closing. So if the seller does not receive the full purchase price upfront in the year of sale, and the deal is paid over time, all right, so there's one or more payment after the year of sale, then the installment treatment will come into play for tax purposes, unless there is an election not to have it apply. And I'll talk about what that looks like in a moment. But the big attraction with installment treatment, installment sales, is timing. So if you are going to take back seller note, and if you're going to help finance the deal, which is one of the reasons why installment sales are used, instead of the seller recognizing all the gain in the year of sale, the seller can recognize the gain over multiple years as the principal is collected on the note. And again, this can help cash flow because the seller is paying tax more in line with when the cash is actually received. And also in the right situation, and I'll show you this in a moment, it may also lower the total tax burden if the gain is spread across years rather than being bunched into one large year. And I'll show you a slide on that in a second. The other thing that these an installment sale or installment note can do is it can also help get the deal done, right? Seller financing can bridge a gap when third-party financing is limited or expensive. So there's also often not only a tax reason, but also a business reason for using an installment sale structure. But of course, again, this is not a free pass. I mean, the gain is not forgiven, it is deferred. All right. The seller is going to recognize gain on the gross profit percentage inherent in the deal. And we'll go over an example of that as principal is received. Now, there's going to also be interest on that note. So the interest on the note is taxed as ordinary income when it's received. So installment sales, again, can be useful, but you have to evaluate the tax timing, the economics, and the collection risk together. So let me give you an example. I alluded to this previously, where installment sale can really work to decrease taxes in total for the seller. So here's a simple example, very simple. We have a capital gain of $3 million. Let's assume it's all capital gain, and it's all collected in a year of sale. And the seller is going to pay a 20%. We're talking federal taxes only here. Tax rate's going to be 20%. It's a capital gain. So he's going to have to cut a check to the IRS for $600,000. But I don't know if most people are aware of this, but if the seller is married and he or she files a joint return, and their joint taxable income is $600,000 or less, then guess what? The capital gain rate goes down to 15%. And by the way, if it falls below $100,000, the capital gains tax rate is zero. Zero. So in my example, if the seller says, you know what, I'd like to structure the deal where the $3 million is paid out evenly over 5 years, $600,000 a year. And let's assume that uh, the couple's other income less other deductions nets to either a zero or a negative number in each of those 5 years. Then their capital gains tax would be 15% of the $3 million over the 5 years, is 600,000 a year. So their total tax will be $450,000 as opposed to $600,000 because they're spreading it out, they're pushing it into a lower capital gains tax bracket, and they save $150,000 over the 5 year period, which is a 25% reduction in tax. Okay, so think about that. It's important. However, there's two caveats here. One, first of all, you got to realize, and the seller has to realize that, okay, by stretching the payments out to get this tax benefit, you're taking on credit risk, right? You're hoping that the buyer can still honor the note. But, you can mitigate that risk with adequate security, such as like having a personal guarantee by the buyer of the note. And secondly, there's some tax risk too, because the tax rates don't know, but they could increase over the next 5 years. So that may take away some of this savings. Okay, but again, I just wanted to point it out that this is something where using the installment sale could produce some neat tax advantages to the seller, but you have to be aware of the risks. So here's a real detailed slide about how this installment sale methodology works for tax purposes. So here we have sales price of 10, tax basis of 2, gain of 8. So the gross profit percentage on this transaction is 80%. Now let's assume in the year of sale, the seller gets $7 million. Okay, and also gets and the next it's also going to get a note for $3 million, which is I think it's at 10% interest. 3-year note at 10% interest, $7 million in year one. So how does the tax look? What is the tax bite on that? Well, in the year of sale, the $7 million, 80% of that $7 million is gain, right? Because we have an 80% gross margin percentage. So that $5.6 million is going to be taxed at long-term capital gains rate of 20%. And then this example is a California one. So you got to add, believe it or not, another 13.3%. So it's capital gain, and it's taxed on the $5.6 million. In the second year, the buyer's going to get $1.3 million in payments. 300,000 of that is interest income. $1 million of that is principal on the note. 80% of that is going to be gross profit or capital gain, tax at capital gain rates, and that's going to be the tax they pay on the capital gains rate at the rates that I indicate there. But the interest income, however, is going to be taxed at ordinary rates at 37%. Okay, you don't get capital gain treatment on interest income. So you can see that the gain is being stretched out over the years in which the principal payments are going to be received, and any interest received on those principal on those notes, so that note is going to be taxed as ordinary income. So here are some of the other things to note about the installment sale treatment, and I want to bring this up before we move on here. Let me go back to the slide. Couple of things to note here at the bottom. It applies only to gains, not to losses. So if you're selling at a loss, you could recognize the entire loss in the year of sale, even if you don't get all the money in the year of sale. The other thing to be wary of, and this catches people by surprise quite often, is that if you have any recapture or ordinary income as part of the transaction, in other words, if the allocation of the purchase price produces ordinary income on the transaction, that ordinary income needs to be recognized in the year of sale. You cannot defer it under the installment sales rules. So you got to pick it all up in the year of sale. Um, and this is again another reason why that purchase price allocation issue becomes important. Now, there's another election. There's an election that the taxpayer can make, and I've seen it happen. I've seen it happen once in my life, and that is you can, for tax purposes, the seller can elect out of this reporting for in some situations, and they can elect out of it. And you may say to yourself, well, why would I elect out of this? Why wouldn't I spread it out? Why wouldn't I, spread my tax over a number of years? Well, I've seen it happen in two situations. Number one, we knew for a fact in the year of sale that in the subsequent year, because of a recent tax law change, the capital gain rate was going to go up. It was going to go from 15 up to 20%. So the seller said to me, and I remember doing it, I'd rather pay it all at 15 now than pay it at 15 today and then maybe 20, and knowing I have to pay 20% on some or all of it in the future. So by electing out of this treatment for tax purposes, you can recognize the entire gain in the year of sale. And that would make sense if you know and you're pretty confident that the capital gain rates are going to go up in the future. The other time I've seen it happen is when the seller, I'm sorry, had a lot of um, deductions or had a net operating loss to offset the full amount of the gain. So the seller just decided to elect out and recognize the full gain in the year sale. But of course, when you do this kind of transaction and you take back a seller note and you have this installment sale treatment, um, there's some business risk, right? The buyer may not make all the payments. So even though the installment sale can help align tax with cash receipts, the seller's taking on some credit risk. And that's why having security, collateral, and note terms are very important here in the tax analysis. And again, just to wrap up here, this installment sale, the seller note can be a smart timing tool, but only when tax deferral and collection risks are being evaluated together. Let's move on to the next topic. Let's spend a few minutes on earnouts. And I think we know what those are, I think. But earnouts are important because it's one of the most important and most common tools used when the buyer and the seller cannot fully agree on value at closing. It addresses the value gap in the business, right? And we talk about that a lot in the growth drive community, right? The value gap, what the business is worth and what it should be and could be worth. Um, so this earnout is a way of dealing with that gap. And so at a very high level, what the earnout does and what it means is that part of the purchase price is contingent on future performance. So instead of paying the entire amount on day one, the buyer agrees to pay an additional amount later if the business hits agreed upon targets. And this is why this is so often used when there's value gaps in the business. The seller believes the company is worth more. The buyer is not ready to pay the full price up front. And now the earnout becomes the bridge. The earnout becomes the bridge between what the seller thinks it is worth and what the buyer is willing to pay. And if the business performs, then the seller will get more. If it does not, then the buyer has not overpaid on day one. So from the buyer's perspective, this is a very attractive tool because it reduces the fixed purchase price at closing and it shifts some performance risk back to the seller. So, and then from the seller's point of view, it can preserve an upside and justify a higher total potential price. But this is where things get tricky at times. Earnouts often sound very simple when you see them summarized in some kind of summary deck, but they become very complicated in the documents. And it really boils down to what metric you're going to use to whether or not the earnout is achieved. So if you use a metric like adjusted EBITDA, if that's the case, then the parties really need to define exactly what that means. What gets added back? How accounting policies apply? Are examples built into the agreement? Who controls the business after the closing? Okay. You got to be able, if you're going to use a metric like a bottom line number, like adjusted EBITDA, you got to make sure you have a full understanding of that. And also, if you can put examples in the agreement to show how those things are calculated. Now, it's more preferable from the seller's point of view that that metric be one that is high up on the P&L as possible. In other words, it's a revenue number or it's a gross profit number. Again, clearly defined. And those numbers are kind of hard for the buyer to manipulate after closing, although they can be, but they're a little bit harder because you're not talking about, you know, the buyer making decisions about overhead allocations, integration costs, but you still have issues around pricing and also accounting methods. So you got to make sure all those things are specifically addressed. The formula is not vague, and and if you don't do that, if you leave it vague, and I've seen this happen a number of times, the earnout becomes it morphs into a post closing dispute. Um, the other issue here is that sometimes these earnout payments are treated like additional purchase price. Most of the times they are treated like additional purchase price. But other times, if they're really tied to the seller's continuing services, they can look more like compensation and be taxed as ordinary income. So you gotta make sure you gotta be aware of that. So again, the practical takeaway here is that an earnout is not just deferred purchase price. It's really a risk shifting mechanism. And it only works well when the metric that determines whether or not the earnout is made is precise, the calculation needs to be transparent, and the post closing guardrails are clearly documented. And oftentimes that there's also, I've seen examples in the agreement actually how, these things are going to be calculated and how certain items are going to be handled. So there's no ambiguity when it comes time to determine whether or not the earnout has been made. All right, let's move on. Let's talk about another concept that comes up in these transactions, and that's about covenants not to compete. Okay, so at a very basic level, the covenant not to compete is the seller's agreement not to turn around and compete with the business they just sold. And from the buyer's perspective, that protection can be extremely important, especially when a big part of the value is tied to the owner's relationships, reputation, or know-how. But a non-compete is not automatically enforceable just because it's written into the agreement. Okay, so you have to make sure that it's reasonable in duration, geography, and scope, and you have to refer to the applicable state law in which the agreement is being executed. So this is not a boilerplate if it really matters. It needs to be tailored to a legitimate business interest and written in compliance with local law. Now, there's also a tax angle here. Okay, it's an important one. Going back to allocation. So any amounts allocated to this covenant not to compete are generally taxed to the seller as ordinary income, not capital gain, ordinary income, which is usually less favorable, of course, than long term capital gain treatment. So sellers typically do not want too much value assigned to this covenant not to compete, if that same value could instead be assigned to goodwill or other intangibles where it would be taxed at capital gain. Now, for the buyer, the economics are a little bit different. The buyer, when they pay for this covenant not to compete, they get an intangible asset that they can amortize on a straight line basis over 15 years. So there is a tax benefit, but it's not a fast tax benefit. They have to write it off over 15 years. And this is why buyer and seller may have different levels of sensitivity to how much value gets assigned to the non compete. And it becomes a real negotiation point. The covenant may make perfect business sense, but the amount allocated to it affects the seller's after-tax result. So when the team is debating goodwill versus non-compete allocation, they are not debating wording; they are debating economics. And as you know, a non-compete is probably standard in many deals, but the way it's drafted and the amount allocated to it can materially affect both the enforceability of it and the tax consequences to both the buyer and the seller. So be aware of the covenant not to compete and amounts allocated to it. Okay, let's move on a little bit and let's move on to consulting agreements and employment contracts. Okay, now because these things are very common after the closing, and they can have a meaningful tax and business consequence. And again, I would say this: these are typically not part of the purchase price for the business, but instead are compensation for services to be performed in the future by the seller. So these are kind of add-ons, not necessarily part of the purchase price. Although sometimes we'll get into that. The buyer may want it to be, but typically they're separate post-closing agreements. Okay, and let's talk about them. So in the case of a consulting agreement, right, the buyer may push for some consideration for the business to be pushed into a consulting agreement so that they can get a faster deduction for the payment. So sometimes the buyer may say to the seller, look, I'll pay you more for the business, but I'd like to push it into this consulting arrangement because you know what? As I make those payments under the consulting arrangement, which is usually no more than 1 or 2 years long, maybe only a year, they get to deduct that immediately. Okay. And even if the seller is amenable to that, I can tell you that the IRS is going to look at that and they're going to look for substance over form. And if they see, for instance, that the services that are required are minimal, there's really not much the seller is going to be doing, and there's a lot of money pushed to this consulting agreement. There's a risk the IRS is going to treat it as part of the purchase price and deny the buyer the immediate deduction and instead require them to write it off over 15 years, even if the seller agrees to it. Okay, so you got to be careful there. I guess the old saying is pigs get fat, but hogs get slaughtered. So you got to do something that's reasonable here when you're allocating a purchase price to a consulting or not a purchase price. If you're going to push some of the purchase price to a consulting agreement, just don't get overly greedy with it. Again, these are the arrangements that keep the seller involved after the deal closes. It's there to transition relationships, train the buyer, preserve continuity of support, and growth during the handoff. And it's especially common in mid-market deals where much of the value still sits with the owner. And again, it's important to also note that consulting and employment agreements are not the same thing, even though people talk as if they are. Worker classification matters. So, the IRS is going to look at who controls the seller's work, how the person is paid, and what the overall relationships looks like. So, this is not just a labeling exercise. The facts have to support the structure. So, if the seller is going to become an employee of the buyer entity, and they're going to be controlled by the buyer, and their schedule is controlled by the buying entity, then the payments are going to be taxed as W-2 wages, taxed as ordinary income, and subject to FICA and Medicare taxes. On the other hand, if the seller is not going to be an employee, but is going to be a consultant, then those payments too are also generally ordinary income, and they also are subject to self-employment tax. So again, this is very different from receiving purchase price proceeds that qualify for capital gain treatment. So anytime you see dollars being pushed out of purchase price and into one of these service agreements, the seller should understand that those dollars may be taxed less favorably. Now, again, from the buyer's perspective, the payments are often attractive because they can deduct them immediately when paid, again, assuming they're reasonable and are truly compensation for services. So, and here's another, I want to bring this up because I've seen this happen too. Here's another potential tax planning idea if we're talking about a consulting agreement here. I've seen sellers get paid for a consulting agreement, and what they have done is they set up a new S corporation to receive that consulting income, and they're working for that new S corporation. They're an employee, and they perform the services. The S corporation receives the consulting income, and then they set up a large retirement plan for themselves in that S corporation, in which they're the only employee. So you may be able to do some creative planning with the consulting income by doing something like that, by sheltering it with large retirement plan contributions on behalf of the seller. And again, I've seen these things go wrong because Forget about putting the tax differences aside because expectations are vague. Okay. You really need to describe what services are are being provided, for how long, how much time does a person have to work, who controls their work, how is compensation determined. Those things have to be clear in the agreement, and the better it's clear, the clearer it is in the agreement, the better the tax position and the business relationship usually are. So again, the takeaway here that one is staying involved to the closing. The issue is not just whether they are being paid; it's how they are being paid and why they are being paid, and whether the structure really matches reality. Any questions on any of this stuff before I go further? Hearing nothing, I will keep going. All right, let's talk about one of my favorite topics, personal goodwill. Very interesting planning idea. Now, but it's interesting because it's probably one of the most useful planning concepts when you have a C corporation asset sale. So this is only applicable again when you have a C corporation that's selling assets. So at a very high level, personal goodwill means that some of the business value belongs not to the company, but it belongs to the owner personally. So think about the personal relationships, the reputation, the referral sources, the individual know-how, or the owner's ability to attract and retain customers. In some businesses, especially owner-driven businesses, a meaningful part of that value may truly sit with the individual rather than with the entity. Okay? So why does this matter? Why is that significant? Well, as we found out, and I think it was the first webinar I did, when you have a C corporation asset sale, the big tax problem is often double tax. Okay, first the corporation pays tax on the sale of the assets, and then when the after-tax proceeds are distributed to the shareholders, there is a second level of tax at the owner level. And that's what makes C corporation asset sales so painful. And we discussed that in a previous webinar. But personal goodwill can come to the rescue here. So if you can identify personal goodwill, you can reduce that problem if part of the value truly belongs to the owner and is sold directly by the owner to the buyer rather than by the corporation. So if that works, then the portion that portion paid to the owner may be taxed at the individual level rather than being taxed twice through the corporation structure and taxed at favorable capital gains rates. Now, from the buyer's perspective, from their perspective, this can still work for them because personal goodwill acquired from the owner is generally still amortizable goodwill if they bought it from the company. So they have to write it off either way on a straight line basis over 15 years. So there can be some planning value here for the seller without necessarily destroying the buyer's economics. But here's an important warning here. Personal goodwill is not something you invent and come up with at the end of the transaction by writing the words into the agreement. It really has to be supported by the facts. The owner really has to be the source of value. And if there are prior employment agreements, restrictive covenants, or other documents that have already been executed and have already transferred those rights to the company, then the argument for personal goodwill really goes out the window. Because then, in that case, the company, the corporation owns that goodwill, not the individual shareholder. So that's the real takeaway here. You got to be careful of that. Make sure that the owner has not entered into an employment contract with his or her own company, which many do not. So it's really not much of an issue. They really don't because they own 100% of it, so they don't need to have an employment contract or any other restricted covenant. So it usually is easily, you can find it and you can support it with the facts. So the principal takeaway here is this: if you have an owner-centric C corporation that's going to have an asset sale, do not automatically assume that all the goodwill belongs to the company, all the intangibles belong to the company. Personal goodwill, as I just pointed out, may be owned by the individual shareholders, and they can create a real planning opportunity. But Again, only when the facts and the valuation support it, and the documentation is there as well. Let's move on. Let's talk about sales tax. Sales tax is this is one that needs to be talked about because it's is one of the easiest issues for advisors to overlook in a business sale. Okay, because when people hear a tax issue, they usually think about federal income tax first. But I can tell you, in an asset deal, when you're selling assets, sales tax exposure may arise on the transfer of tangible personal property, and that can become a real cost if no one addresses it early. And the key point here is that sales tax is generally not imposed on the entire transaction just because a business is sold. It usually applies to the taxable tangible personal property, things like equipment, furniture, fixtures, and sometimes inventory, depending on the state and the facts. And this is why structure matters, right? Because if you did a stock sale, you can avoid this issue entirely because the corporation continues to own the assets and there may be no direct transfer of tangible property. Okay. And of course, you can do a stock sale and get asset sale treatment by having a 338(h)(10) election in effect. But there is also stuff that can come into if you don't have that opportunity. If you can't sell stock and a stock sale is out of the question, there's also some other planning tools that can come into effect here, like a resale certificate for inventory held for resale. Because I know in the state of Florida, if you're buying inventory to resell it again and you're a reseller, you have a resale certificate you present to the seller, and you don't have to pay sales tax on it. Or the occasional sale exemption, which exempts the entire transaction from sales taxes. But again, these rules are highly state specific, so they should never be assumed. You gotta bring in appropriate tax counsel to look at this before you get too far down the road, and then the sales tax pops up. And of course, the purchase price allocation matters here as well. If more value is supportably assigned to Goodwill and less to tangible personal property, that may reduce the sales tax exposure, although it also changes the income tax result. So the full picture has to be considered. So the takeaway here is this: anytime you see an asset sale involving equipment, fixtures, and furniture or inventory, ask whether sales tax has been analyzed. It may not be the biggest tax in the deal, but it often is one easiest to miss. All right, let's go to another topic that, again, this may not come up very often because it only applies when there is an acquisition of a C corporation. And it's specifically when there's an acquisition of C corporation stock. And it has to do with NOLs, which stands for net operating losses and tax credit carryovers. And, at first glance, a buyer may look at a target with large net operating losses and tax credits and think, great, I'm acquiring a built-in tax asset here, right? I'm going to buy this company. It's got millions of dollars in NOLs. Boy, that's a real benefit for me when I take over. But there's caution here. And the caution is that those tax attributes are often limited after a stock acquisition. So the practical value will be much lower than the headline number suggests. And the reason for that is in the Internal Revenue Code, there's provisions to prevent people from buying corporations just to gain access to their losses and their credits. And if there's a more than 50% ownership change over a rolling 3-year period, that can trigger this limitation, this Section 382 limitation regime. And this is where the valuation comes in. So what happens if you are in this situation, and I guess you're the buyer in this case, but the seller needs to be aware of it too, is that the use of the NOLs is going to be limited to an annual limit. And the annual limit is going to be based on what the fair market value of the company was at the time of sale, multiplied by a published IRS rate, which is an interest rate. And that the product of those two numbers, fair market value at the date of sale and this published interest rate, is the annual limitation on the use of these NOLs and tax credits that the buyer can actually use each year. Okay, so be aware of that. If you're a seller, you're representing a seller, has NOLs the buyer's going to know, they should know, and they probably would be advised to know that NOL is not worth uh, its stated value right away. It could take years for them to be able to use them. So the right question here is, if you're on either side, is how much of it is actually usable, and over what period and under what limitations. So this can affect price and structure, right? The seller is presenting NOLs or credits as part of the value story, but the buyer is going to verify whether or not they're really available or whether they should be treated as a speculative upside instead of a core value. So NOLs and credits uh, may have value, but they're not cash and they're not automatically transferable. That it's not an automatically transferable value to the buyer. In many stock deals, they are limited, so they're not a full asset upon acquisition. Okay, so what are the key takeaways here?
Does
Let's
that
wrap
go,
up.
does that go away if you do a 338H10?
If you do a 338H10,
Do the NOLs go away?
well, if they're used up in the hypothetical sale of the assets, they would go away. But if not, they're still there.
I got you. Okay. Thank you.
Okay. Well, I talked a lot. Let's wrap this up. We're almost coming up against our time here. We only got about 8 minutes left. So let's talk about key takeaways here. So let's tie this together at a practical level. The first thing is in today's session is that transaction tax issues are really just a technical footnote. They often shape the economics of the deal, and the seller's after-tax cash, the buyer's deductions, and the risk that shows up after closing is important here. So if I had to reduce the whole presentation down to a few practical reminders, that would be these things right here. First of all, purchase price allocation matters because the buyers and sellers usually want different things, and negotiation directly affects the net economics. To both to the seller and the buyer. So purchase price allocation matters a lot. Be aware of depreciation recapture because a gain on depreciated assets, in most cases, is going to come back and be taxed as ordinary income, not capital gain. Thirdly, installment sales can be used to bridge the financial gap when a business is sold. It's seller financing, and it also aligns tax with cash receipts. So you don't pay until you get paid. You don't pay the tax until you get paid. But they also bring about interest income, which is taxed as ordinary income. And if you have ordinary income type items in the sale, they're going to be recognized right away. You can't defer them. And you have the collection risk associated with, the seller note. You got to be cognizant of that. Fourthly, let's talk about earnouts. We talked about earnouts. Earnouts can bridge a valuation gap, but only if the metric that measures whether the earnout is made or not is clear. The calculation is clear and transparent, and the post-closing rules are clearly defined. Non-competes and post-closing service arrangements are not boilerplate. They affect legal enforceability, tax character, and negotiation leverage. Personal goodwill is a very powerful planning opportunity in the right C corporation asset sale scenario. But again, only if the facts and documentation support it. And finally, sales tax and NOL limitations are classic examples of issues that can be very easily overlooked and expensive to ignore. So if I had to give you one closing thought here, I would leave you with this. You as a mostly, I would say, non-tax advisor does not need to know every code section here, but you do need to know where the tax landmines are. All right. Your value is often in spotting the issue early, asking the right question, and getting the right specialist involved before the economics are locked in. And that's all I have for today, guys. And as the series continues, I'd like to just announce that the next session is going to shift now from these tax-sensitive deal terms. We're going to shift now into some non-tax deal terms that affect sellers' cash at closing. Specifically, we're going to talk about working capital targets, cash-free, debt-free concepts, post-closing adjustments, and indemnity-related items. And I believe the next one is a week from today. Which puts it at June 24th. Excuse me. Anyway, um, that's all I got. Thank you for everyone. Thank you everyone for attending today. And if you have any questions, feel free to reach out to me with any questions or any comments. I did post a copy of the slides in the in Circle, and if you have any questions, we have a couple of minutes left. I'll be glad to take them. We have 5 minutes left, so if you have any questions, shoot away.
This is tax related, but not specifically on what you talked about, Mike. But are you a fan of the deferred sales trust?
Yeah, I've heard about the deferred sales trust. Excuse me. So do people understand what that is?
I don't
Who are
know.
on the call? Okay. So once you explain it to everyone, you looked at it, right?
Well, yeah, it's a utilization of the installment sale by putting a trust between the buyer and the seller. So
Right.
the trust receives the money and then pays the buyer over time, and that causes a deferral of taxes. And
Right. Right. So what happens, just to go back, so what happens in that case, there's a trust put between the buyer and the seller, right? And the trust now owns the business, and the trust sells the business to the buyer, and the buyer pays the full amount into the trust, right?
correct,
But the trust is not controlled by the seller. The trust is controlled by an independent third party trustee.
correct,
All right. And that third party trustee then takes all that money from the sale of the business. And then, um, let me go back. So the seller, the original seller, sells the business to that trust in
right,
return for a promissory note or note.
correct,
The trust now owns the business. The trust sells the business, gets the full amount of cash, and now the trustee of the trust is going to pay off the seller on that note over time.
right,
And then you're going to get to spread out the gain and defer the tax and all the stuff, all the it could be the great tax benefits of the installment sale, but you kind of reduce in a way the credit risk, right? Because the trust has all the cash.
right.
So you don't have that credit risk. The only thing I've seen them and I've talked to people about them and I've introduced them to some people, there seems to be a little bit of a uncomfortableness with them not controlling the cash.
There's that, and you can't get a private ruling on them.
That too. Yeah, you can get legal opinions, but they're not worth very much because that's just someone's opinion.
Right.
And you're not going to get a private letter room because the IRS, sometimes these things are abused. But even if that was valid, even if it could work, I've had people tell me that I don't like the fact that I don't know what this trustee, who this person is, and what they can do, and I have no control of. I mean, they can take my money and invest it and lose it all, and
Right.
I get nothing
Correct.
on my note. So there's that. So we talk about there's no credit risk. There is some credit risk, even though someone has all the cash. You don't control all the cash. So
That's correct. My observation is you're either a fan or you're not.
no, I kind of like it, but then I'm putting the tax benefits aside, and I see it being it's still risk. It's still risky, and a lot of people can't get comfortable with it because they don't necessarily feel comfortable with someone else who they don't know, has to be an unrelated party, controlling that money.
I'm good with that. That makes sense. Good. I don't want to get too far down the rabbit hole. I just was wondering what your opinion was.
Well, again, I present them and I tell the client these are the benefits, these are the risks, and then they make the call. Um, and then of course you have to caveat it saying that there's no IRS position on this. We don't know if they work or not. But I know the people who promote them will tell you that, well, we've been through a bunch of audits, and they've never been challenged. And that may be the case.
Yeah,
Uh,
I'm with you. I'm with you. Very good. Thank you. Thank you for your time today.
any other questions? Was
Uh,
that you, Mark, who asked that, or someone else?
That was me.
Oh, okay, Mark. Yeah. So yeah, I've been trying to find things that people can utilize to reduce, the gain on the sale of the business or stretch it out. And, you know, um, deferred sales trust is one of them. Um, there is, but you know what? Someone, if you think, well, this is, I don't know if you're aware of this, but I'll throw it out there. So the taxpayer can really create their own deferred sales trust if they give themselves enough time. And what I mean by that is if they sell their business to a non-grantor trust that is set up for the benefit of their family, and they have a trustee in there that it could be, it could be an unrelated party, but it may even be a related party. If they set up a non-grantor trust at least 2 years before the sale of the business, they can sell their business to the non-grantor trust in exchange for a note. The trust has to wait 2 years. All right. And then when the business is sold 2 years later, all the money goes into the trust. And then the trust can then pay the original seller on the note that the seller took back when they sold it to the trust in the first place.
So they would get the trust would get a step up on that
Yeah.
purchase price.
Correct. There's a full
Eight-
step up. It's a non-grantor trust. It's not a grantor trust. So it's a different party. They get a full basis step up on the sale, the first sale. And then when they sell it, they pay whatever the difference between what the selling price was 2 years ago and what it sells for now. They pay tax. But then the rest of the tax is not paid until the original seller collects on the note. And I've heard some of my estate planning attorney friends tell me that that note can be as long as 25 to 30 years long. So
Yes.
you can really stretch out the capital gain. And then going back to the discussion we had about taxable income and capital gains rates, uh, who knows? I mean, you could push that into lower tax brackets. You can get it down into a 15% tax rate every year if you want, or you could do stuff like that. You could kind of control the taxation of the sale, but you got to have 2 years because there's an installment sale rule, related party installment sale rule that says that if you sell it to a related party like this trust, and the related party turns around and sells that asset within 2 years, then if the related party collects on the sale, that note that you have is considered to be paid in full when they collect on the sale. So that's what happens if the trust sells it within 2 years. But if you have 2 or more years, or more than 2 years, I should say, then the entire gain is not taxed. It'll be taxed to the trust, who will have a basis step up based on what they paid for the note for the business. And so you reduce the tax there, but the original tax then can be spread out for years.
Gotcha.
But a lot of people don't seem. I explain that to them, but they don't feel comfortable selling it yet to a trust, because what if the sale never happens? What if I can't sell it? Now my this trust owns it and I don't own it anymore. So you got all those issues. You gotta navigate that.
Perfect. Thank you. That's
All
really
right.
good. Yeah.
All right, guys. Or Matt and anyone else, Mark and everyone else that's listening. I'll sign off now. I think we run over a little bit,
All right.
but we'll see you next week. Any questions, feel free to contact me.
Thank you.
Bye now.
Bye.